Good afternoon. I'm Brent Wilsey with Ms. Chase Wilsey. We're from Wilsey Asset Management, and welcome to today's Smart Investing Daily Briefing. Today we're talking about corporate debt increasing too fast. Well, as a percent of GDP, which is gross domestic product, is now 45.3%. Going back to the first quarter 2009, it was 45.9%. So we're coming back to a higher level again, after being so low for quite a while. What's going on here? Well, many companies are buying back their stock using debt to buy back their stock. A couple of things here. One is they're saying, hey, it's a good time to buy our stock back, but as opposed to repatriating the money, paying the taxes on it, it's better off that they borrow for that. But make sure if you do that, that it makes sense for the company. Make sure they're not buying back stock just to buy it back. Make sure that they have profits, they're not getting over leverage. Many important things to look at if you're using leverage to increase your buybacks.
Exactly. One thing kind of talking about borrowing money, interest rates are extremely low right now. So what this does is it really helps out on the return on capital. If you're borrowing money at low interest rates, it's, hey, we can afford to do that because we don't have to have as high as return on our money that we would if interest rates were 6-7%. Really important here, understand the difference between ROE and ROC. Now, ROE is return on equity. When a company goes out and buys back their stock, the return on equity is going to increase, but the return on capital is going to decrease if they take on too much leverage. So always important to take a look at these two numbers. And as you said, many companies are refusing to repatriate because they say, hey, I can borrow at 2% versus pay 30% in taxes.
Exactly. Well, this is a company that's kind of done this here, and that is Apple Computer. The current price on 108, the high 123.82, the low 89.47. We can see right now, down from the lows somewhat, so could be a good buy. Let's take a look at the numbers. Fiscal year-to-date repurchases, $23.45 billion. It's actually bigger than a lot of companies' market cap combined, so they've been very aggressive buying back their stock. That's kind of funny. Their sales are down 1.8%, earnings down 1.1%. If you hear the news, you think, oh my gosh, it's falling apart for Apple. But again, they have such a big base and selling, again, they've sold their 1 billionth iPhone, that it's hard to keep sales growing at 10% on a 1 billion of sales.
Yeah, and bottom line, they are continuing to make money, continuing to generate cash. And one thing that amazes me with Apple is their balance sheet. As you can see, current ratio 1.31, and I was shocked by this. Quick ratio 1.29. So they do have a very lean balance sheet, meaning they don't have a ton of inventory there. Now they are one of these companies that have been buying back stock and issuing debt. Their debt to equity now stands at about 67% and have about over $200 billion overseas now. So they have a ton of capital overseas that they can't access due to the high corporate tax rate. Going out to September 2017, estimated earnings per share are $8.85. This gives you a target sell price of $146.03. That's 30% over the current price, so I still like where Apple is.
Yeah, I think some good numbers as well. So I hope you enjoyed this edition of the Smart Investing Daily Briefing. If you'd like a free report on the 5 big mistakes investors make,
give us a call at the office. Our phone number is 858-546-4306, or go to our website, smartinvesting2000.com.